Hey everybody, my name is Shane. I'm the events over at 10 Capital Network, and we have a great one about investing in healthcare today. So with that, if you have any questions, of course, put them in the chat box and we'll get to them if we can. I'm going to unlock that now. We're starting a little bit late, so I'm just trying to run through things. But I'll pass it off to Hall, our CEO, now to boot it up.
Great. Thanks, Shane, and thanks everybody for joining us today. We're recording it for those who can't make it. And today we're talking about investing on the bleeding edge, how healthcare is the most dangerous and lucrative investment. We have Michael Schmanke of AngelMD that's going to lead us in that topic, and supporting him is Joe Macaluso, who's also a medical doctor as well. I see we have some in the audience who are there also with MD degrees. We're then going to have a presentation from Vicki Farrar of Lightline Medical about a new technology that's coming up that you'll find very interesting. And we'll close out with physician advisory shares and how that works in this program at a high level. So with that, let's go ahead and introduce Michael. Michael, if you go ahead and put your slides up and kick us off with this. And again, if you have questions, just put them in the chat box. We'll be glad to answer them as we go along.
Dr. Macaluso and I are here to talk a little bit about investing in early stage startups and how it's an extremely risky field, but if you do it right, there's some amazing opportunities out there. And I like to think about it as, almost like that shtick, with great risk comes great opportunity, right? And that's what we're talking about today. So to start with, why do we care about startups, particularly in the current market? Well, right now, what we have is what we call a late cycle investment period, where the Fed is on a rate hiking cycle. We don't really know what else is going on, but we can see the impact it's had on, say, the SPAC, the bubbly stocks that went off around the easing of monetary policy and around COVID. That includes the SPACs, the COVID darlings like Zoom that we're on right now, or Peloton and those types of companies, or like the next generation tech that got so popular there for a while, like whether that's electronic vehicle speculative. I mean, there was a SPAC that went out there for asteroid mining at one point. So that was all very much in focus when money was easy. But now that rates are higher, we see those same speculative stocks getting hammered. And instead, money's been rotating towards mega cap, mostly because they're hiding in a place because they have no idea what to do. And why they not know what to do? Well, because no one's really sure what the long-term impact of the rate hikes have been. As Warren Buffett famously said, you don't really know until the tide goes out, you don't know who's been swimming naked. So until we actually see the impact of these higher rates flow through the economy, we don't know who's over-levered, whether that's individual companies, or whether that might be China, or whether that might be Spain and Italy in terms of sovereign debt risks. So there's a lot of things out there. And so I can think about it as, it's a mad, mad world. Like, you don't really know what different things are going out there. So what you really need to do is decide for yourself whether you want to hide and hunker down in a situation like that, basically, but just investing in, a balanced portfolio of indexes and bonds, or whether you want to follow the crowd by chasing the next cool stock. And that could be Meta, or that could be Tesla, or that could be some mid cap that you heard from your dentist. Or do you want to travel off the beaten path and try to find your own opportunities? And that's obviously what we are suggesting today. And frankly, it's why I got into this business. So when we talk about that in terms of why I got into this business, from my 20 years on Wall Street with an engineering background and all the other things, why am I here talking about medical care and healthcare startups? Well, everything that I talked about in terms of the dangers of the current status of the market are what we call cyclical trends. Rates go up, rates go down, inflation goes up, inflation goes down. Different parts of the cycle, you invest in different things. Instead, if you really want to be a smart long-term investor, like the Warren Buffetts of the world, think about what the secular trends are. The secular trends are those things that are changing over time. And while they might revert at some point, there isn't like a natural break point where they automatically sway. So some examples of that would be the aging demographics of society, where populations are just not having more than 2 kids per couple, as the result that you have population declines across the entire economic world, across all the G20 countries in particular. You have countries like South Korea, where the birth rate per woman is like around 0.8. They are literally looking at in the face of cutting their population in half over the next 2 generations. So when we think about what that means, think about what those other types of secular trends may be. first and foremost that I like to think about is that information is king. And what does that mean? Well, if you go back to the feudal era, right, or before that, labor was your primary capital input, whether that was building pyramids, Roman roads, or tending farm and growing potatoes. Individual human labor was the major input. When you get into the Industrial Revolution and mercantilism, you see that capital, like physical capital, whether that's in the form of rolling steel stock or whether that's in the form of gold and dollars and pounds, building stuff, that was your primary input. When you think about the captains of that era, you think about the railroad barons, you think about the JP Morgans of the world, you think about the British tea companies and the East India Company and how they ran a mercantile world. Capital is the major input of that entire society. So what's happened now in our modern era is that information is king. And we see this everywhere, whether that's that the biggest companies in the world are tech companies, Apple and Google and Microsoft and Amazon, right? What is their real asset? Their asset is intelligence and intellectual property, right? So in this world that we live now, information is king. It's always best to be investing in companies that have IP as their primary asset, healthcare startups. We also want to, I don't want to get too much into detail with these other secular trends. I just want to give you an idea that these are all set up that way. The other ones that are there are the fact that there's a global rise of secondary countries. Like for the bulk of the last few decades, we concentrate on the US and Europe as your two primary markets, right? Well, you have billions of people now whose GDP per capita is starting to rise up into the point where they start demanding actual quality healthcare. So you have billions of people's worth of purchasing power looking to buy better healthcare devices, but they need to be innovative, they need to be cheap to deliver, and they need to be equally to deliver in terms of access points, right? Think about like inflation and all of its impacts that has on all of our inputs. And so do you really want to go into buying McDonald's as an investment when they have labor costs that could scale with inflation? Or do you buy an asset like a healthcare startup whose input costs are really irrelevant to inflation, and yet their output can scale with based on their pricing power? And further, let's just point about that what all of this means in terms of your single payer programs. Now, in the United States, obviously, we have private healthcare, but those pricing points are still set by Medicare and Medicaid. And woe be any startup that isn't thinking about Medicare and Medicaid as being their primary client, that they need to think about reimbursement levels and fitting into the workflow and getting approval from that standpoint. So as government budgets are being squeezed across the world, both from the aging demographic, from the inflation hits and the rest of their economies and other aspects, they're all looking to mash down on expenses. What does that tell you? There is a global mandate to cut costs and deliver higher quality outcomes to this growing and aging population. And the only way that you're going to get that, the only way you're going to square that circle is by investing heavily in innovation. And that's where we get to. So opportunity set is huge. Entry points are huge. I could spend an entire half an hour talking about the structure of capital markets, why healthcare startups and early stage companies are your particular investment point. That's frankly a topic for another class. However, I do want to talk about how do you de-risk these investments in this incredible sector. So there's remarkable opportunities. We've discussed the secular trends that make you want to be in this space, but how do you take some of that risk off board? Well, everybody needs a plan, right? Every man needs a plan. So you're first and foremost, educate yourself on the nature of the healthcare area, just understanding the sector, how it's different than other investment sectors, how regulatory approvals, stages of companies, types of companies, all reflect your decision-making process. And essentially, come to these types of meetings and hear people talk about how they make these decision processes and educate yourself around what happens. For that matter, just watch a lot of pitches based on what the startup founders are pitching to you while they're trying to raise capital will tell you everything you need to know about what people think is interesting in this space. And they may do a good job. They may do a great job, like we hope Vicki will do later tonight, or they may not. But having a variety of this as an input is a really good start. So that's number one, educate yourself. Number two, your basic blocking and tackling of core investment strategies. And that's including knowing the team you're going to be investing with, doing the basic due diligence on this. Do they actually exist? Is this something that's a purely speculative investment that you're going into with a napkin and a dream? Or is this something where they've actually performed the bench test, they have the product, they're ready to go to market, they have a definable process to get to market, and you can have confidence in them as a team to execute. So those are your two cores: educate yourself, doing your basic blocking and tackling. The same kind of thing you would do if you were buying a car or a house. Just understand what you're getting into. Finally, and this is why Joe is here today, the single biggest trick that I can tell you, and what has made me so much of a better investor in this space over the years I've been in it, is talk to the specialists. If there's anything else that I can drill in, if you take one thing away from this conversation at all, it's simply that this is not like other sectors in that specialty information is required, but specialty information can give you a huge advantage in the space. If you're looking at Lightline, talk to some urologists, find out whether this is something that's relevant. Talk to hematologists, talk to anyone that's doing a dialysis and what their inputs are. Go to the specialists and get their feedback. We at AngelMD, that was our entire reason for existence, is the opportunity to put potential investors in touch with specialists in their field to give feedback on the companies themselves. And with that, I'd like to hand it off to Dr. Macaluso. He's not going to talk about urology or Lightline or anything. Instead, he's going to talk a little bit about his decades of experience of investing in the field and the point of view of an actual practicing clinician in the decisions that he has made over time and what he does. So with that, I'd like to hand it off to Joe and talk about what are the first questions that you think about when you have a company. When Vicki comes and presents to you, what's the first thing in your mind that you need to ask?
Well, I've been doing this a while, and I ask everybody the same series of questions. It never really changes whether they tell me they just walked out of the garage with an idea last week, or they tell me they've been at this for 5 years and they've got all this other stuff in fundraising. First thing is, what are they doing? What are you doing that's so special? What is the problem you're trying to solve, and why is the thing that you're doing going to solve the problem or greatly advance the problem solution compared to what does not exist at all, or what does exist but it's not as good? That's the first thing. Hopefully that can be articulated. It should be able to be articulated simply, particularly if you're reaching out to non-medical investors. And that doesn't mean they can't understand it, but if you're going to get into a lot of jargonese and scientific, stuff, you're going to lose them. Then who else is in the field? I mean, how did you get here? If this is a problem and there are other people, what are they doing, et cetera? Are you advancing the standard of care? Or are you doing something truly transformational, truly innovational that could be really a breakthrough? Money. How much have you raised? From who? Friends and family is usually the answer you get, seed money. My favorite question is, how much money do you have in the bank today? Not how much you expect to get next week, or who you've been talking to that's about to invest, or what DOD grant you're about to get, or on and on and on. What do you have in the bank today? And I have gotten answers from 40, 50,000, 500,000, all the way as low as $400. And I must tell you, the $400 one just raised $2 million, because that was one of the most truthful answers I ever heard from anybody. And that's a medical startup. How much are you looking to get and why? What's your funding ask? A lot of companies are in this, what I call the sweet spot between friends and family and the bigger check, meaning the $200,000, $500,000, $750,000 ask, because they have to get certain things done to get from that seed position to the next big check that kind of puts them into a different level. Who's running the company? What's their history? Have they run companies? Have they done exits? Have they had any experience with regulators? Because in the healthcare field, the regulatory side is very important. Are you a drug? Do you have to go through the whole drug thing with the FDA? Are you a device? Are you a device that can do a 510K, which is going to be an add-on? Are you something that doesn't even need that because you're a software application? You're another type of thing. You're a cybersecurity that prevents ransomware for hospital systems. So it depends on what that factor is, because that's the pathway you're going to have to follow, and that your investors will have to follow to get you from point A to point B to point C. I always ask this: what is your exit plan? I'm amazed at how many companies do not have an exit plan, or I get the answer, well, we just started out, 6 months ago. I'm like, so what? Exit plan should always be a line item on you, even if it's on the back of a napkin. It should be a line item on your business strategy so that at least it's being thought about. Doesn't mean that you have one, doesn't mean that you even know how it's going to turn out, but at least it's something that gets 5 minutes of discussion every time you sit down to look at it. Strategic partnerships. Do you have any? Are you reaching out to any? What would be the strategic partnership that you would want? Who are the people that you would be reaching out to if those things don't exist? One of the big things I look for, and I've learned all these things the hard way, trust me, are the founders, the CEOs, the developers, are they married to the company? Meaning,
And I just wanted to interject here that this is specifically, Joe and I sat down, I said, Joe, what are the biggest red flags? The things that when you see them come up, you just run the other way. You're like, no, not for me. Everybody else can look at it, not for me. So please, sorry.
I absolutely. And I've learned this the hard way. I mean, when I deal with a founder, whether it's a business related founder who's got a medical person they're working with, or it's a medical founder, doctor or scientist, if they are married to the device, the drug, the concept, whatever it is, meaning that they really don't want criticism, that no matter what input they get, they go back to point A. This is my baby's perfect. I run from that because those people are they're a drain. They really never seem to move forward. The other one that I didn't even mention here, but the other one is what I call the dragon slayer. That's the person that has an idea they're married to, and they're convinced they're going to be the next Bill Gates. They're going to be the next Warren Buffett. I run from those immediately because they're never going to want to exit. They're never going to want to partner. They're never going to want a co-investor of any size, a company of any size to partner with. And it's just a waste of time. Obviously, IP is king. I know Vicki's going to talk about IP later. That's sort of her sweet spot. If you've got intellectual property, if you've got patent portfolios, if you've got patents pending, that's great. Utility patents and the like are okay, but they really are not much. You really are, ideally, if you've got something that you can put a stake in the ground, so to speak, with a patent or a patent pending, that's great. In medicine in particular, if the thing you're doing is going to require, and I spent a lot of time working with very large companies on medical ergonomics. If the thing you're going to do, whether it's a device or a process issue or a drug or a software, whatever it is, if it's going to require a massive change in the system of delivery, I always used to use the example, if I'm going to, as a surgeon, if I'm going to be required to do this left-handed upside down with one eye closed, I'm probably not ever going to use that. So if there's something that's so radical, unless it is, and this does occur, not often, unless it is so transformational that the system will absolutely have to do it, then the system will change. But that is not a common factor. You want to make sure that whatever is there can fit into the ergonomics of process, the ergonomics of delivery of care, whatever the technology is that you're talking about. How is the business incentivizing the stakeholders? But by that I mean, what is the advantage to a physician, to a hospital, to a clinic, to a payer, to Medicare, to a private payer, to whoever, to actually get into this, use this drug, use this device, use the software, whatever it may be. And lastly, is it so far-fetched that it sounds like it's Star Wars? It does, as Michael put down there, doesn't pass the sniff test. Now, theoretically, that's okay. It can be far-fetched if everything else is in place and it makes sense based on the entire case that's been built. But if it's just sort of, out there in left field and it doesn't have the underpinnings of logic or science, you just got to walk away.
If they know what they're talking about, they will give you detailed answers, or they will give you the single best answer that I love is, I don't have the answer for you that right now. Let me get back to you with a very detailed response. Like it shows they know what they know and they know what they don't know, and they're not here to BS you and baffle you with bullshit. They want to blind you with their actual brilliance. And if that means that they have to wait a day to give you the best answer, great. But this is like Joe's poured about the $400 in the account. I want honesty and clarity and true transparency, and I'm a big fan of that.
And the best ones really are the ones that actually know the answer, but perhaps the answer is more detailed than the time allowed for that initial conversation. And literally they'll say, look, I have it. Let me get you something. And I've had many cases where you stop the Zoom call, you hang up the phone, you leave the meeting, and within an hour or two or less, you've got an email or a text or something. It says, here's the link, and you've got a whole, thing. It's like, oh, these guys are for real. These folks know what they're doing. So, I mean, there's a lot of this is common sense and obvious, but you'd be amazed how, certainly myself, when I started out doing this, I transitioned from doing pure R&D work to merger acquisition when Boston Scientific, who I worked with for many years, went public in the early 90s. And I had to learn this from the ground up. And you'd be amazed at how easy it is to get hypnotized and mesmerized by the story. And then you kind of forget all these other questions. And the story, you're just like, yeah, I'm ready to go. I want to get on the rocket tomorrow and take off from Mars. And like, well, wait, what? Do we have enough oxygen? Do we have enough water? How am I going to get back? We're going to be able to eat. You kind of forget all those questions, and you learn the hard way that.
It's very funny because, as Joe said, these seem like they're very basic and direct, but it is surprising how many companies come across our desks that don't meet these things or that have these red flags. There's a reason we have these as decision sets, and it's because it works, because it actually will. If you think about why this matters, think of a portfolio of 10 medical startups, right? Any medical startup on average, let's say, has a 10-to-1 payoff on an exit. So you've got your portfolio of 10 names, 9 of them go bankrupt, 1 of them pays off 10-to-1, and you are flat in your portfolio, right? So you didn't lose any money, you didn't make any money. Now, if you can take 3 of those 9 companies and eliminate them using this filter process, you all of a sudden go from 9 failures to 6 failures, and now your portfolio is up 30 or 40% at the end of the year, right? So just eliminating a couple of dogs from your portfolio will turn you into a better investor than most Silicon Valley VCs, because I'm going to give you a little piece of information on that. Most of them are awful at that too, because they're all out there hunting for lottery tickets like they're like standing in a Powerball line and looking for that 1,000-to-1 payout, and that's all they care about, which is why so much money flows into therapeutics, because those have those 1,000-to-1 payoff profiles, right? And people ignore your blocking and tackling of the really cool companies that have a much higher probability of succeeding, but might have a payout that's in that 10 multiple range.
Well, I want to also interject. I mean, of course, the poster case study for all of that in Silicon Valley is Theranos. That was a total disaster, and those people obviously either they didn't get medical input, or they did and just were so mesmerized by the story, as I said, hypnotized, that they said, oh, it doesn't matter, we believe it. They were basically into a cult. It was an issue of faith, which didn't pan out. But the other thing to remember is there are a lot of companies that are in the healthcare space that don't appear to be healthcare, that require different thinking. I'll give you 2 quick examples. I had a company I was working with not long ago, several years back, and we started talking. I got to them through a different thing, through the Defense Department, and they were in cybersecurity. And they said, well, we think we have some healthcare things, but we're really not a healthcare company. I said, well, tell me a little bit more. And they said, well, we're really working on this thing for ransomware protection for hospital systems. I said, well, you're in healthcare. And they said, well, that's not really what we do. I said, I know, but if you're working on ransomware to protect hospital systems or Medicare, you're in healthcare big time. So they were in healthcare. The other thing is I have another company that's a very narrow focused company that does pathologic testing that's innovative, because it takes a test that requires in-hospital operative procedure and moves it to the doctor's office. But the thing is a test. It's not a device in the sense, it's not a drug, it's not a therapeutic innovation, but it's a test. So therefore the whole market, the whole customer base is very different. Customer base is not hospital per se or a drug company. It's really a pathology company. It's a laboratory company at the end. So you have to kind of really think about these things, and you have to have people who understand all the different aspects of the market if you're going to go into healthcare investing, because it depends on where they fit in the system, and they fit in different places, and how they fit. All these questions about, I said about, that's all the same. They all work, they all fit. It's just how do those individual investments fit within whatever niche they're playing in the health system.
Well, if there are no questions from the crowd, are there? Hall, any questions?
If anybody in the audience has a question, please post it now. And I did have a question myself for you guys when you finished.
Yeah, I mean, I've got my one last kind of observation that I ask everyone, and it's a bit of a jerk kind of question, but it's a good one. I always ask them at some point, what makes you so goddamn special, right? And I don't mean as an individual, but as a solution. If this is a problem that's acknowledged, it needs to be solved, what is the actual core innovation or change that has occurred that makes the solution available now when it wasn't available 5 years ago, 10 years ago, or before this? Or is it something trivial that you just think that you're going to implement and no one else is going to pick up on? You're never going to get competition in the same space. Like, there needs to be something critical that you've figured out that's different from everybody else. That's what's going to create the barrier to product. That's what's going to generate that ability to really change the market. Those things are what really matter. So please, Hall, you said, yeah, that was all I had left to say.
Great. Yeah, so my question is, when I see a life science deal, I get to the IP slide, and sometimes there's one patent, time there's 10 or 15. And how do you deal with that? What initial filter do you put on that list without having to go look it all up and really dig into it to say it's a good strategy, or no, that's probably not good? Is there any rules of thumb you use with looking at IP slides in this world?
The first and easiest is the proper mix of actual patents versus use or utility patents. Like, you want to see the real core patents to exist. But I'm going to let Joe take the bulk of this answer, because I know he's got way more experience on this specific topic.
Well, again, it depends on where you are, where that company is posturing themselves within the system. So if you're a device company, obviously pure patents are important, because that device should be unique. It should have innovative features. I mean, I've done patents, and when you go to a patent attorney, they want to know what are all these unique things, and they can list them, all the claims, boom, 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 boom. And obviously, the more claims you have, the more defensible your patent is, assuming that the patent actually is not just sort of a knockoff. Because a lot of patents, they're unique, but they're like this much unique compared to what was out there. So they're able to get patented, but they're not really significantly different than a lot of other stuff. They're just slightly different. There are other areas, and that would be true with drugs as well, but there are other areas where patents are kind of loose, you know? I mean, it's hard to patent certain things, or it's difficult to patent certain things, or patent them completely the way you would a drug or device. Therefore, you kind of have to look at what the concept of the company is and how they're innovating a problem in the system. Because usually that's an ergonomic, that's a process issue, could be software, could be a different type of delivery, could be a patient application for virtual care. It could be any number of things that are a little more difficult to patent, but it doesn't mean they're bad. It just means that, okay, you got a utility patent, or you don't have any patents. I mean, I've worked with some that have no patents, and you go, oh, and then you think about it, well, what are they going to patent? I mean, it's kind of hard. What they're doing is implementing. Now, that's more difficult, because the problem with those companies is if they've got a great idea, but it's not able to be uniquely controlled, they need to exercise their plan quickly, because everybody else is still in that field working. And if they miss their sweet spot, their exit, their partnership, their contracting, somebody else will come up and do the same thing in a similar or better way. So it just depends. And that goes back to evaluating the leadership of the company. Are they looking to really move the thing forward? Are they going to drag their feet? I mean, et cetera.
Vicki, by the way, has patent law experience, and she's actually chimed in the chat. Vicki, why don't you give your answer right here for everybody?
Okay.
And we actually use this as a bit of a transition to your presentation as
There's
well.
a transition, Vicki. After that, go ahead and jump to your pitch.
Okay.
Perfect.
So a patent does not mean that you do not infringe somebody else's patents. Okay. So what you really want to ask is, do you have written freedom to operate opinions? Freedom to operate opinions means patent attorney has found that your planned commercial product does not infringe another patent. A patent doesn't give you the right to sell your product. It gives you the right to sue somebody else for infringing. So you can have a whole lot of patents and never be able to get your product on the market, or if you do, you're subject to infringement suits. This is something that most people I don't understand. And all the pitches that I've done, I've never heard another entrepreneur say they had written freedom to operate opinions.
I've never had that either. Absolutely. You're the only one.
Well,
But-
and that's
but
why
it's-
we wanted to bring her in on
But
this. and
it's
why-
absolutely critical. I mean,
Also-
it's more important than having a patent. Ring doorbell had no patents.
All right. Well, great, Vicki. Appreciate the answer to that question. And let's go ahead and shift over to your presentation.
Okay.
Vicki is with, and let's hear your presentation. Again, if you put them in the chat box, and at the end of this, we'll talk about physician advisory shares.
Okay. I'm Vicki Farrar, the CEO of Lightline Medical. We're using visible light to prevent all catheter-associated infections. Question: are you afraid to go to the hospital? You should be. Hospital-acquired infections are a huge international problem. In the US alone annually, they cost $50 billion, 100,000 deaths. Most of these events are never events. They should never happen, and therefore they're never going to be reimbursed. But on top of the lack of reimbursement are staggering Medicare penalties in the hundreds of millions of dollars more. More than 40% of these infections are catheter-related. Do we care? Are catheters really a big deal? Yes. They're one of the best medical miracles of the century, but infections limit their use, limiting care. Why? Why can't the world fix this problem? It's because so many of the drugs used to treat these infections are antibiotic resistant. In fact, antibiotic resistance is now the third leading cause of death worldwide. We have the solution. It's called the Lightline Photo Disinfection System. We're using visible light, that's light that the human eye can see, not harmful UV light. The technology consists of two components: a reusable light engine attached to an off-the-shelf catheter. Inside the catheter is a fiber optic that emits light inside and outside, disinfecting it and thereby preventing infection. This is a platform technology that enables the best treatment for all types of catheters: dialysis, urinary, respiratory, and vascular. And there is no antibiotic resistance issue. Said another way, the bacteria simply cannot resist our light. The device works. We have successfully killed the microorganisms that cause these infections and exceeded FDA's 99.99% kill rate required for an antimicrobial claim. First, we're putting the technology in a peritoneal dialysis catheter for several reasons. It's generally understood that peritoneal dialysis done in the home is better for the patient clinically and their quality of life than hemodialysis done in a clinic several hours at a time, several days a week. Then how come in the United States, 89% of the population is on hemodialysis? Here's why. Scared to death of getting an infection, and we can fix that. The second reason this is our first product is that we're putting the fiber optic in a portion of the catheter here called the extension set. It's where more than 90% of the infections arise. As a result of it being outside the body, not touching human tissue, we don't need to do animal or clinical testing, so we have a straightforward 510(k) pathway. Their device works seamlessly within the workflow of the peritoneal dialysis patient. At the beginning, they start doing whatever they would ordinarily do, and then they have to do 4 things with our product. They have to turn on a switch on the back to turn this light engine on. They have to test this light cable, and when it turns green, you know it's working. They attach that to the extension set that you just saw, and they push the start treatment button. Now, our treatment will last, will take place while they're doing their drain. So it's something they already have to do. Then it will turn off automatically and they continue to do everything else they would do. We have a partnership distribution plan where we rely on a partner's existing market penetration. We have that, and I'll show you that for a minute when we get to our urology product, but we don't have it yet for our peritoneal dialysis product. So we will do direct sales at the beginning. After we file our 510(k), we will hire a head of sales. We will then have an initial market release, then a targeted regional release. And by the second half of 2025, we'll have a full launch, and we will, for sure, we believe, have a distribution partner by then. This is a huge market. There are over $10 billion total addressable market. We estimate that by 2033, we'll have over $500 million in revenue and approximately 17% of the worldwide population. But next is the Holy Grail. We put the technology in a Foley or urinary catheter to prevent catheter-associated urinary tract infections. These are the most common infections in the world, not just the United States. It too is a 510(k), but it's a de novo 510(k), so we need animal and clinical trials. That's why it's product number 2. This too is a huge market. There are over 100 million Foley catheters sold worldwide. As I mentioned, we have a partnership distribution strategy, but here we have that distribution agreement with Medline Industries. That's the largest private distributor in North America with 50 infectious disease sales reps. We estimate by 2033, our revenues will exceed $400 million, or 6% of the worldwide population. We estimate 10 years post-launch revenues exceeding $1.7 billion. But how do we make money? Here's how. For peritoneal dialysis, we have a razor blade model. We give away the light engine for free or charge a nominal amount, and we charge $70 once a week for the fiber optic. That fiber optic needs replacing once a week, and that will be an 80% gross profit margin. For all other indications, we charge for both the capital equipment and the fiber optic, but for the other indications, you only need one fiber optic for the time you're in the hospital. Competition. Virtually every competitive product or the standard of care disinfects from the exterior of the catheter. Example, you've got alcohol swabs, gloves, antimicrobial coatings. We are disinfecting from the inside out, and we disinfect the interior and exterior of the catheter. So only light does it all. We kill established biofilm, we kill drug-resistant microbes, can be used long-term, and are safe for material. Here's a competitor that has a peritoneal dialysis product in development. They're using bleach. Yep, sodium hydrochloride solution. And they are putting that bleach literally in the extension set that we showed you where we're putting a fiber optic. Huge issue. We have no potential toxicity to the peritoneum or other organisms. They do. They have an additional device they have to wear. We don't. They require additional tubing. We don't. They don't disinfect during treatment. We do. We also have other applications, urinary, respiratory, and vascular. They do not. As I mentioned, we disinfect inside and outside. We can also treat multiple locations simultaneously. We have complete control over where that light targets. It's going to target only where we etch that fiber optic. Foley catheter, most people know, and BARD is the primary competitor here. As you may know, there are penalties given for catheter-associated urinary tract infections. BARD silver-coated catheter will be our primary competitor, but everyone knows that silver degrades over time. Similarly, the silver does not disinfect on the inside and outside of the catheter. But why? Why would anybody buy our products? It's because we have a strong value proposition for everyone. Patient doesn't get an infection, caregiver isn't treating an infection, hospital isn't penalized for it, and insurance companies aren't paying for it. And how do we know we can get these products on the market? We've all done it before. I have deep intellectual property experience, and so my last infection control company, Catheter Connections, to Merit Medical, Merit put $1 million in Lightline. My co-founder at Catheter Connections, Bob Hitchcock, he's our chief technology officer. He's been putting products on the market for decades. Kristen Taylor is our CFO. She's been putting products on the market for 30 years, both in public and private companies, and has worked with multiple startups. Kelly Powers, he recently retired from CR Bard and Bard Access. He's put over 100 products on the market with revenues exceeding $15 billion. Here's where we are. We're raising a Series A of $6 million, of which $1 million remains. Pre-money valuation, $18 million, price per share, 69 cents, and warrant coverage, 8%. We're using all of that money to do everything we need to do to file for FDA clearance of our first product. We will then raise a Series B. We'll have a significant increase in valuation, and that Series B will be used to commercialize the peritoneal dialysis product and to develop and launch the urinary product. Traction. Our data is conclusive. As I mentioned, 99.99% kill rate. We've had over 50 in vitro studies, 2 animal studies. We're doing a lot of the testing required for FDA. We've done human factor studies. We have peer-reviewed journal articles, and literally on the efficacy and safety of life, there are hundreds of publications. So what have we done that's so important? Here's what we've done. We have figured out something that nobody else has ever done: how to target the light uniformly and consistently at the right duration and the right intensity to kill those microbes, thereby preventing infection. IP, our secret sauce. 30 issued patents, 19 pending, and written freedom to operate opinions that I talked about. Now, you can't patent visible light because it's a natural phenomenon. We have not patented visible light. What we have patented is the method of delivery. And it's not the number of our patents that's so important, it's this. What it means is that examiners all over the world have found our technology novel. We also have collaborations and partnerships with Mayo Clinic and Medline. I already mentioned Medline. I'm going to talk about Mayo in a minute. We've won lots of grants and awards, and we've raised $10 million with notable investors listed. Our agreement with Mayo is very important. We have licensed from them their know-how in all 4 fields of use, and we have a weekly meeting on peritoneal dialysis with a nephrologist. Purpose of that meeting is to get our product right, not just for Mayo's clinics, but for every dialysis patient. We also have access to everything at Mayo. We secured funding from them, and they negotiate at best price. Here's what that means. It means that they will be an early adopter and a catalyst for others to adopt our product. Timeline. I mentioned we're doing everything we can right now with our Series A to file our 510K. There will then be an increase in valuation. We raise a Series B, we launch the PD product, followed by Foley and endotracheal. Now, you don't see vascular on here. That's because we're convinced that we're going to be sold well before we get to vascular. And that being said, we have confidentiality discussions with 2 public companies right now on vascular. The point of this slide. It's not that these are the entities that are going to buy us, it's that we've got multiple potential exits. We have 4 fields of use, and we can do a deal internationally or domestically for each. Example, Fresenius is a dialysis company. They don't only want dialysis, but Medline and Teleflex may want everything everywhere, and Bard BD may want selected indications in selected geographic areas. Just showed you what could happen potentially with 8 exits. We've modeled 1 exit here. Typically, a medical device company sells for 3 to 5 times revenues. I sold my last infection control company for 5 times revenue. We estimate that approximately 4 years post-launch will be at $400 million in revenue. That's an exit valuation of $1.1 to $2 billion, or a 32 to 54 times return for a Series A. What we want you to do is join others that have gone into our data room and done their diligence. AngelMD, Kaiser Doctors, Keiretsu, which is an angel group, Mayo Clinic, Medline, and Merit. With your investment, we can get within reach of this 510K clearance. We can successfully eliminate antibiotic resistance, save millions of lives, billions of dollars, launch on time, and deliver extraordinary returns as well as revenues. Thank you.
Great. Thanks, Vicki. Those in the audience have any questions, please post them in the chat box. Question is, what's the go-to-market strategy? Where do you want to enter the market first when you go to the market?
Okay, so if we don't have a partnership distribution agreement with one of the big boys, Medline, I'm sorry, not Medline, Baxter or Fresenius, Baxter and Fresenius, sorry, DaVita and Fresenius own most 75% of the dialysis clinics in the United States. There are, though, 800 independent clinics that are not owned by Fresenius in dialysis, and where we will start will be with the top 3 of those 10 clinics.
Great. What's your biggest challenge you see coming up in the next 2 years?
Okay, that's a very good question. So market adoption of a novel product is hard. There's just no question about it. So we will need to be laser focused on our market research, our market collateral, how many, we have a plan that I went through very briefly for the peritoneal dialysis of our sales plan. And what we'll do, we have to execute on this, not perfectly, but hard. So we need to hire a bunch of sales reps. We got to get the sales training right. We got to get our branding and marketing collateral right. We need a key opinion leader strategy and podium strategy, and we need to establish logistics. That is all something we all have experience doing. And we have a head of sales identified. He was my VP of sales at my last company. So we really have to focus on that. And then next, at the same time, we need to develop that peritoneal dialysis, the Foley product. So we'll be doing those 2 things at once.
Great. And Michael, Joe, what questions did you have?
Well, I mean,
We've spoken a lot with Vicki, but I'd like just to interject one thing here, and that's when you talk to a company like DaVita, why would they be interested in using this product versus others? Because I felt like that was a really important thing when we were talking.
Sure. And we are in discussions with DaVita as we speak. And I will say, want to mention one thing, that we have just signed a contract with DaVita to open up their clinics for us to do our human factor studies required for FDA to interview their patients and their nurses. Okay. That being said, peritoneal dialysis, as I mentioned, it's not disputed that it's better for the patient clinically and their quality of life than hemodialysis, but it's also $15,000 a year cheaper, and yet the provider gets the same exact reimbursement. So if it costs DaVita $15,000 less per patient per year, that's money they put in their pocket. Also, an infection prevention product here will keep the peritoneal dialysis patients on peritoneal dialysis longer so they can make more money. Also, end-stage renal disease patients that haven't even decided which modality they're going to do first are way more likely to go on peritoneal dialysis, because the number one reason they're not on it is the fear, the absolute fear. Patients are panicked about getting an infection. So it's really, forget even the quality of life issue. For DaVita and the providers, it's money.
and remember, in the case of the big boys that you're talking about, Fresenius and DaVita and all, they really only have one payer they're dealing with, because end-stage renal disease is the only disease state, regardless of age, that is covered by Medicare. So if you're 20 years old and you have end-stage renal disease, you're on Medicare. And therefore, these people, their primary payer is Medicare. As Vicki pointed out, currently it's a lump sum payment, basically. So, but keeping a patient off of hemodialysis, not only is it better for the patient, not only is it better for the health system because of the demands of hemodialysis on the patient and so forth, it's better for them financially because they are doing better. And the other thing to remember when you talk about why would hospitals be interested or outpatient clinics, one case of sepsis and peritonitis, that would pay for hundreds of these units to be used or catheters to be used, because basically one case of that, first of all, can cost tons of money. I mean, literally millions of dollars. Secondly, it almost surely disqualifies that patient to some degree from returning to peritoneal dialysis, whether that's for 6 months or a year or forever. So there's a lot of reasons why peritoneal dialysis and the prevention of peritonitis is the best place to start.
Yeah, and I might mention that there are now a tremendous amount of financial incentives for the providers to get their patients on peritoneal dialysis. And there's one program called TIPNIs, where if you can show the federal government that within 2 years of your FDA clearance, you have a clinically significant impact, then they will reimburse the provider 65% of your capital equipment here. So that would be our light engine. Also, the federal government has made a goal of having 80% of the population on home dialysis by 2025. Well, I don't think that will happen. Fresenius, DaVita, Baxter, everybody has said that they are pushing to get more patients on home dialysis. Home hemodialysis is going nowhere. That's a 1 or 2% of the population. So what they really mean is peritoneal dialysis. And those entities need a differentiator. Why should you use Fresenius's products and not Baxter's? So whoever gets our product first, I think, has a tremendous advantage.
Great. We have a poll there. If anybody, please put on the poll itself. If there are any other questions for Vicki, please go and put them into the chat box. And the last minutes I'd like to take, I would like to tell that we do have a fair number of other companies like this one that are on the FDA path, and almost all of them, actually all of them, have a substantial number of physicians in there as investors on their cap table. And many of them are looking for more physician investors to join and actually perhaps do some advisory work for the company. This ranges quite a bit based on where they are in the process and what they need. But if you're a physician and you are interested in learning more about this, put in a question in the chat box and I'll be glad to answer those, or we can talk about it afterwards as to what they offer and who is looking for support in this area. So, okay, let's see, we have an initial question here. So is there a minimum amount to invest? Typically that's around 50K, but it does vary from one group to the next. And then based on what you can offer and help that company, advisory shares for that. And they range quite a bit as well, based on how much time and effort goes into it. Any other questions there? Give me a chance to type that in. Like I say, about 1/3 of our companies are a medical device or a therapeutic that is on the FDA path, and there's just a great deal of work that needs to be done to move these things forward. But with that, looking forward to seeing any further thoughts you guys have about that. We'll be reaching back after this to see who's interested to learn more, and then we'll start to talk more detail about what each one's offering and what might be a good fit for you guys there as well. Vicki, what are your final words there on your presentation?
Well, I would just say, following up on what you've just said, is that doctors really, at least for my company, they understand better than anybody else the value proposition. And that's why we have so many doctors. We recently closed around with AngelMD, but also, Mayo Clinic and lots of Kaiser doctors, et cetera. It's just they understand the presentation, the value proposition.
Great. Thanks, Vicki. Any closing words from you, Michael?
Oh, I would only say that whether you're watching this live tonight or as a recording later, if you have any requests for topics that you would like to learn more about, make sure you tell Hall and the team at 10 Capital, and we'll see if we can arrange some other courses that maybe dig into different aspects, whether it's in the finance and operations and individual side like that is more of my specialty, whether it's about the clinical experience and insight that you get from a specialist in the field that would be absolutely Joe's specialty, or whether it's another topic entirely that we have resources that we can get experts in just about any field to talk about stuff that you want to talk about. So that's all I would say.
Great. Thanks, Michael. And Joe, your final comments?
Main thing I would say is that aside from my medical expertise, I do feel like I have a lot of expertise in startup fundraising. And as you know, Hall, I am hoping that we can eventually capitalize this massive Texas triangle, Dallas, Houston, San Antonio, Austin, and everything in between and nearby, into sort of a juggernaut of financial support for startups, because we have all the resources here in Texas that we need for anybody, whether they're coming from Texas or from outside of Texas.
That's great. I agree. We're based here in Austin, Texas at 10 Capital, and I'm glad to have you guys join us tonight, and looking forward to seeing you in future events as well. And with that, we'll go ahead and close it out from there, and see you guys next time. Thank you so much.
Thank you very much.
Thanks. Bye-bye.